Ever wondered why your business shows profit on paper, but your bank balance tells a different story? The mystery often hides in one simple number: your cost of goods sold, or COGS. Most entrepreneurs skip this calculation and end up making wrong pricing decisions. In this video, you will learn how to calculate cost of goods sold of your business. Whether you run a small online store or a global brand, understanding COGS can change how you see your business profits forever. Let's start with what COGS actually means. Cost of goods sold includes all direct costs involved in producing or purchasing the items you sell. Think of it like this. If you sell a pizza, your cost of goods sold includes the cost of flour, cheese, toppings, packaging, and labor directly involved in making it. But rent, electricity, and marketing aren't part of cost of goods sold. They're operating expenses. By separating these, you can measure how efficiently your products are made or sourced. This clarity helps you identify whether your pricing covers real costs or if you're unknowingly selling at a loss. Now, let's move to the formula. The standard cost of goods sold formula is COGS equals to opening inventory plus purchases minus closing inventory. Imagine you start the month with $10,000 worth of goods, buy $5,000 more, and end the month with $4,000 left. Your COGS equals to $10,000 plus $5,000 minus $4,000 equals to $11,000. This means you sold goods worth $11,000. It's that simple. Businesses use this calculation monthly or quarterly to find how much they spent to generate sales. Once you have your cost of goods sold, you can subtract it from total sales to find gross profit, which is the foundation for every financial decision. Let's apply this practically. Suppose you run a t-shirt brand. You had 500 shirts at the start of the month, bought 300 more at $5 each, and ended with 200 shirts unsold. So, opening inventory equals to 500 times 5 equals to $2,500. Purchases equals 300 times 5 equals to $1,500. And closing inventory equals 200 times 5 equals to $1,000. Using our formula, COGS equals 2,500 plus 1,500 minus 1,000 equals to $3,000. This means it cost you $3,000 to sell those t-shirts. Now, if your sales were $5,000, your gross profit is $2,000. That's how you know whether your business model truly works. Many business owners make one big mistake. They forget hidden costs. If your product requires packaging, shipping, or assembly labor, include those in cost of goods sold. Ignoring them gives a false sense of profit. Another mistake is not updating inventory values regularly. Prices change, and your inventory value must reflect that. Use accounting software or spreadsheets to keep track. Accurate cost of goods sold ensures accurate gross profit, which then helps in tax filing and financial analysis. Remember, every decision, from pricing to scaling, depends on knowing how much your product really costs to make or buy. When you track COGS monthly, you gain control over your profit engine. If your COGS percentage rises over time, it signals inefficiency or supplier issues. Smart entrepreneurs constantly work to lower COGS without hurting quality, by negotiating better rates, reducing waste, or improving production methods. This single number decides your survival in competitive markets. So, before you plan your next growth strategy, calculate your cost of goods sold today, because if you can't measure your real cost, you can't manage your real profit. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.